Welcome back. Joining me now for a look at the day's markets action is Muhammed Wagley from Sasfin Wealth. Muhammed, thanks so much for joining us today. So positive momentum across the board with most indices trading in the green. Surely it's that momentum, that earnings gains we've been seeing from Nvidia, right?
And Taling, thank you so much for having me. Yeah, pretty much the way I see it, it's got to be the Nvidia results. Now, I think loads of people were sort of nervous about this. The share's done nearly 350% since the start of last year. And I suppose the question is, how much further can these guys go? So there's a lot of worry about, the results coming out. But once again, they shot the lights out. We're talking triple-digit increase in profits on a year-on-year basis. Same with revenues. And so, yeah, they really did well. Stellar results once again. And I think that really served to buoy the market as a whole. As you say, we're picking up a lot of risk on sentiment. And I really don't think I've seen this much green for quite some time when it comes to the JSE.
Right.
So, yeah, quite a good day.
Quite a good day. I feel like everyone even forgot about the Fed minutes that came out yesterday with those minutes kind of pointing towards higher rates for longer. Do you think that market participants kind of overestimated or thought that these rate cuts were going to come sooner than expected?
It definitely seems that is the case. I think by and large, we had priced in that by March, maybe at a stretch May, we'd be looking at these cuts coming down. I think what happened is, we saw the Fed be a little bit more optimistic come the end of last year, and we saw the market rally on the back of that. I think, they're taking that into account and they're being sort of a lot more cautious. And that's sort of, more in line with the overarching narrative that we have seen for the Fed. So to answer your question, yeah, I think it may be a little bit, the rates might be a little bit longer for quite some time. Perhaps we're looking at June now. That's really the reality of it. But they're definitely going to be sort of deliberate, careful about this. There's been a lot of emphasis placed on the 2% target, and that inflation being there sustainably is key. So, yeah, probably pushed back a little bit. But as you say, it seems like the market didn't even notice.
Right. Now let's get into some local company results. Earnings season is heating up here in South Africa, and we've had miners out with downbeat results. This was expected on the back of those weaker commodity prices. I wanted to start off with Anglo American. It was no exception, with earnings tumbling over 90%. I think what I found interesting was the decision to write down De Beers value. It's also in the process of reviewing its assets. Mohammed, what have you made of that move and its overall performance?
Yeah, so it's not sort of that out of the ordinary, for these diversified miners to be reviewing sort of the mix that they've got, especially given sort of where they are in the cycle. Market reacted quite positively to this, which means, a lot of this was priced in. It's no secret that they've been under quite a bit of pressure. We had two previous sort of diversified miners come out in BHP and Glencore the previous 2 days. And I think by and large, this sort of re-gearing or optimizing the portfolio that they're looking at doing, which will probably take about a year, is good news and makes sense given the context of where we are in the commodity cycle. We also saw the numbers came in, or some of the numbers at least came in a little bit better than expected. I think the debt figure was a bit lower than expected. That's another thing the market likes. But it does make sense. It's not uncommon that you'll sort of move away from commodities that are perhaps less revenue generating than others. And the big miners are sort of, they've got enough scale to actually make those pivots. So that doesn't surprise me, and it doesn't necessarily surprise me. The market did react well to this, despite the fact that you mentioned, all those earnings were down so substantially.
And I just looked at that share price graph. It is up 2.99%. So basically 3%. Market participants kind of welcoming or not taking this in a bad way, right? So let's move over to some gold miners, which have been doing fairly well, right? But benefiting from that gold price. However, higher costs and lower output has hit Gold Fields. Despite this, the miner is quite positive about its prospects, pegging its hopes on the launch of its mine in Chile, right?
Yeah, so it's quite an interesting one. I think we got Harmony and Goldfields earlier today, and there was quite a contrast. Now, Harmony was up handsomely on the day. You mentioned Goldfields lost a little bit. The real difference, the key difference here, and it's, I suppose, even maybe a bit counterintuitive, but Harmony operates predominantly in local mines, whereas Goldfields has a much bigger sort of global presence. Now, the weaker rand really stood to benefit Harmony, but in that sense, Goldfields didn't really benefit from that. Now, in my mind, we actually got good news that they're trying to expand a lot more in Chile, and this is part of, a long-term overarching strategy. But I actually think it was the weaker rand that really benefited the one company over the other. And I also think the contrast that the market would have seen maybe put a little bit more pressure on those Goldfield numbers.
Let's move over to some announcements from retailers. Pick n Pay is making big shifts. The retailer is planning to raise a 4 billion in a rights issue as its debt piles, and it's also looking to list Boxer. I'm quite surprised about Boxer. What did you make of that move?
So it's quite an interesting one. So Boxer's actually done quite well. They point to that in the results, but really Boxer needs to expand. Okay, and the share has fallen, I suppose, from when I last checked, around 16%. It should be there or thereabouts as at close. But really what put the market into frenzy here was that not only did they need to raise sort of the 4 billion rand from the rights issue, but they also needed to unbundle Boxer to raise relevant funds. Basically what they're saying is that 4 billion capital raise on its own is not enough. So really the picture that is being painted here is a company whose balance sheet is under sort of enormous stress. Now, you mentioned Boxer doing quite well. Like, the reason that I suppose the unbundling will help them is because Pick n Pay has really been funding that expansion. And I suppose, to take a bit of pressure off from Pick n Pay there and have maybe, I suppose, the public do it would really benefit Pick n Pay in that regard, as well as Boxer, because they do really need to expand. But yeah, a bit of a frenzy here. It's not necessarily new news,
yes,
but I suppose it just reinforces the narrative of, retail struggles, especially within the context of South Africa.
Especially as we have seen cash-strapped consumers dealing with higher interest rates and just really, really going through it. Muhammad, before I let you go, what is your stock pick?
Well, I've gone for something a little bit different today.
Okay.
Usually I'll go with big blue chip American companies. This one is slightly less blue chip, but still a quality company. So the company I'm going for this week is The Trade Desk. Now, essentially what they do is they provide sort of an alternative to Google and Facebook within the digital advertising space. Now, to sum it up really simply, I would say think of a stock exchange, but instead of transacting on shares, you're transacting on digital ad space. So The Trade Desk doesn't actually sell ad space. They provide ad agencies with an exchange in which those agencies can buy and sell their ad space directly to clients. So now just to, I guess, contrast this against the companies I mentioned earlier, Google and Facebook, if you want to advertise on one of their platforms, you kind of have to pay the price they want you to pay. So Trade Desk allows you some type of price autonomy, which you can imagine advertisers really like. And in light of this environment where interest rates are quite high, advertisers are looking to get a lot more bang for their buck. And I think that really stands to benefit the Trade Desk. In addition to that, it's also an election year, and I think it computes that we're going to see a lot more spend in that space. So I think Trade Desk is very well positioned for the near future and for the long term. It's a very interesting company. I would encourage people to have a look at this one. But I must note the share is quite expensive. It's probably been expensive since it's been listed, but I do think that it is important to have some type of exposure in the sort of digital advertising space. And if you've not got Google or Facebook, this is definitely an attractive option. I would encourage people to have a look at this one.
So Trade Desk, one to look out for. Muhammad, thanks so much for joining us today. It was lovely catching up with you. That was Muhammed Wagley from Sasfin Wealth.